Ever wondered how a single acquisition can reshape the landscape of retail real estate? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In a significant move within the commercial real estate sector, Ram Realty Advisors, based in Palm Beach Gardens, Florida, has completed the acquisition of a 600,000 square foot retail portfolio for a staggering $200 million. This portfolio, anchored by prominent grocers such as Whole Foods Market, Sprouts Farmers Market, The Fresh Market, and Harris Teeter, spans 7 grocery-anchored shopping centers across the southeastern United States. The properties include Main Street at Midtown in Palm Beach Gardens, Florida, Homestead Market and Bull City Market in Durham, North Carolina, Holly Springs Crossing in Holly Springs, North Carolina, Main Street Village in Hilton Head Island, South Carolina, the Market at Mills Park in Orlando, Florida, and Bly's in Oakland Park, Florida. According to Abby Cox, who reported on this development, the portfolio was 98.7% occupied at the time of sale, demonstrating the high demand and stability of grocery-anchored retail spaces. The transaction was handled internally by Ashley Salpaugh and Brian Maloney of Ram Realty. This acquisition highlights the continued interest and investment in grocery-anchored centers, a trend that has been prevalent in the U.S. market. Riyadh's commercial real estate market is witnessing an impressive surge in the second quarter of 2025. This growth is driven by strong economic fundamentals, increasing foreign investments, and a rising interest from global companies looking for prime office spaces. The city has positioned itself as a central hub for business activity in Saudi Arabia, attracting both domestic expansion and international attention. According to the latest report by Savills, Riyadh's Grade A office space occupancy rate is at an impressive 98%. The market has also seen a year-on-year increase in average rents by 10%, indicating a positive trajectory for the city's office market. A notable trend in the leasing activity is the growing demand for larger office spaces, with 50% of leasing inquiries in the second quarter of 2025 being for spaces exceeding 1,000 square meters, a significant rise from 28% in the first quarter. The banking, financial services, and insurance sector continues to dominate Riyadh's office leasing market, accounting for 50% of all leasing transactions in the second quarter of 2025. Legal services and pharmaceutical firms account for the remaining 50%. Furthermore, 46% of leasing inquiries came from companies based in the United States and the United Kingdom, highlighting Riyadh's growing appeal among international businesses. Saudi Arabia's strong economic performance is significantly contributing to the demand for office space in Riyadh. The kingdom's non-oil gross domestic product saw a rise of 4.9%, with an overall growth forecast of 3.5% for 2025. The Purchasing Managers Index reached 57.2 in June 2025, indicating a thriving private sector with strong hiring momentum and business activity. Foreign direct investment is another key driver of Riyadh's commercial real estate market, with Saudi Arabia attracting SAR $22.2 billion in the first quarter of 2025. This represents a substantial increase from the SAR $15.5 billion in the same period of 2024. Several high-profile multinational corporations, such as BNY Mellon and the London Business School, have established regional headquarters in Riyadh during the second quarter of 2025, further demonstrating the city's attractiveness as a business hub. Infrastructure upgrades, such as the Riyadh Metro, which recorded over 25 million passengers in the first quarter of 2025, are enhancing the city's connectivity. These improvements support the demand for office space and bolster Riyadh's appeal as a business destination. The metro system increases accessibility to key commercial zones, making it easier for businesses and employees to navigate the city. Rental growth in Riyadh's commercial real estate market remains strong, with Zone C experiencing a 15% year-on-year increase in rental rates, while Zone A follows with nearly an 11% rise. Despite the upward trend, a slight softening of rental growth is expected by late 2026 due to the influx of new Grade A office space, with over 900,000 square meters expected to be delivered through major developments such as Diriyah Gate and Misk City. New York City is taking bold steps to address the issue of empty commercial spaces, particularly in the wake of the pandemic. According to a report by NBC New York, new incentives are being introduced to encourage the utilization of these vacant spaces. The initiative is aimed at revitalizing commercial areas by offering financial benefits to businesses willing to occupy and rejuvenate these spaces. The incentives include tax breaks and grants designed to lower the financial burden on businesses. This move is expected to attract a diverse range of businesses, from startups to established companies, looking to expand their footprint in one of the world's most vibrant cities. The city's strategy focuses on transforming underutilized spaces into thriving business hubs, which could significantly boost local economies and create jobs. As reported by NBC New York, the city is also working to streamline bureaucratic processes, making it easier for businesses to navigate the complexities of leasing and converting commercial spaces. This approach is intended to expedite the transformation of empty properties into active commercial sites, enhancing the overall appeal of New York City's business landscape. These measures reflect a broader trend seen across major urban centers in North America, where cities are actively seeking solutions to fill vacant commercial spaces. By offering incentives and simplifying procedures, cities like New York are positioning themselves as attractive destinations for business growth and innovation. Fulshear Central, a new development, is set to transform Houston's fastest-growing suburb into a vibrant lifestyle center. This ambitious project aims to create a dynamic community hub that combines residential, retail, and entertainment spaces, catering to the diverse needs of the area's rapidly expanding population. The development of Fulshear Central is a response to the growing demand for mixed-use spaces that offer convenience and accessibility. By integrating residential units with retail and dining options, the project seeks to provide a seamless living experience for residents. This approach aligns with the broader trend of creating walkable communities that minimize the need for extensive commuting. The Lifestyle Center will feature a variety of amenities, including green spaces, pedestrian-friendly pathways, and community gathering areas. These features are designed to enhance the quality of life for residents and foster a sense of community. By prioritizing sustainability and connectivity, Fulshear Central aims to set a new standard for suburban development in the region. According to Florian Martin, who reported on this development, the project's strategic location is expected to attract a wide range of businesses, from local startups to national chains. This influx of businesses is anticipated to create job opportunities and stimulate economic growth in the area, further solidifying Fulshear's status as a desirable place to live and work. The Fulshear Central project reflects a growing trend in real estate development, where suburban areas are being reimagined to meet the evolving preferences of modern residents. By offering a blend of residential, commercial, and recreational spaces, developments like Fulshear Central are reshaping the suburban landscape and redefining what it means to live in a suburban community. As Houston continues to expand, projects like Fulshear Central highlight the importance of thoughtful planning and development in accommodating population growth. By creating spaces that prioritize livability and sustainability, developers are paving the way for a more connected and vibrant suburban future. On Oahu, the retail sector is showing signs of resilience as it rebounds from the challenges posed by the COVID-19 pandemic. According to Alexander Lugo, a commercial real estate reporter for Pacific Business News, Oahu's retail vacancy rate has finally returned to pre-pandemic levels. This recovery has been bolstered by steady tourism and job growth, which have provided a much-needed boost to the local economy. Despite these positive developments, the retail sector on Oahu is not without its challenges. Businesses continue to face economic pressures, and the sector's growth is tempered by ongoing concerns about rising costs and supply chain disruptions. However, the steady influx of tourists and the island's strong employment figures are helping to mitigate these issues, offering a glimmer of hope for retailers. The Colliers Hawaii report highlights several key trends in the Oahu retail market, including the opening of new stores and the expansion of existing ones. This activity is a testament to the resilience and adaptability of the retail sector, which is finding ways to thrive despite the challenges it faces. As Oahu's retail sector continues to recover, it's clear that the island's economy is on an upward trajectory. The combination of tourism, job growth, and retail activity is creating a positive feedback loop that is benefiting businesses and consumers alike. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.